Hi friends, this is Ravi Kanth Miriyala. Right, my classes on CA final paper number 1 financial reporting are available on Unacademy platform. Yeah, these are recorded as well as live, and it is 100% comprehensive and 100% English batch, wherein we discussed each and every concept of Ind AS, which will be useful to the students even after qualification for practice purpose. Also, this will be useful. Yeah, please, inform your friends about this information. And on an academy platform, comprehensive batch on GFRS also is done. 23 classes, 69 hours, entire ICA material with PY examination questions and mock test papers also are covered in this discussion. It will be very much useful for CA final GFR, that is paper number 6E. Next, for my books, that is on Ind AS made easy, our financial reporting made easy, and fast track summary book. Yes, you can order in ravikantmiriyala.com, or you can contact the given number for the books. Right, for your doubts, clarification, please join the Telegram group Ind AS discussion group RKM. These charts are from Quick Revision Fast Track book on financial reporting of mine, which is available in my website ravikantmiriyala.com, and it is available in the market as well. Let's look at Ind AS 36, impairment of assets. Yeah, see, this is impairment of assets. It is only for assets, not for liabilities. Obviously, it doesn't make any sense, right? And this standard is obviously not applicable for inventory because it's already measured at cost RNR, whichever is lower, deferred tax asset, and plan assets are measured at fair market value. Financial assets impairment is dealt by Ind AS 109 specifically. That's why it is not dealt by the standard. Biological assets are just, it's measured at fair market value minus selling cost, so there is no point in it. Insurance assets, ignore it because it's not in your syllabus. And assets held for sale. Assets are held for sale, always measured at book value or fair market value minus selling cost, whichever is lower. So in most of the circumstance, it is already measured at fair market value or NRV or fair market value minus selling cost. That's why it is not applicable. In case of financial assets, remember, financial assets impairment is dealt by that Ind AS 109 specifically. When do you say there is an impairment? When you say your book value is greater than the recoverable amount, then I say there is an impairment. Yeah. What do you mean by recoverable amount? Recoverable amount is fair market value minus selling cost, or the value in use, or the value in use whichever is higher, or value in use whichever is higher. Fair market value minus selling cost or value in use whichever is higher is called recoverable amount. Yeah. And what is value in use? Value in use is nothing but present value of the future cash flows. By using the asset and even from selling the asset over its life, how much future cash flows will come, that you have to turn into present value. That is what value in use. There are so many other points which obviously will be part of the discussion. Next, fair market value minus selling cost. Fair market value, you are supposed to refer, that is exit price. If you want to sell the asset, what is the amount you will get it, which is discussed and defined by Ind AS 113. When it comes to selling costs are incremental cost. What all the cost I am going to incur because I am selling. If I had not sold, I would have not incurred. Those costs only you are supposed to consider, right? And when I say carrying amount is not the original cost. That is cost minus accumulated depreciation minus accumulated impairment loss. After deduction of these three things, what comes is equal to carrying amount, right? I told you, if the recoverable amount is less than the carrying amount, there is an impairment loss. What is the amount of loss? Loss amount is book value minus recoverable amount, that is impairment loss. Then how do you account for? Now first, do you have any revaluation reserve with respect to that specific asset in the balance sheet? If you say no sir, then this impairment loss will be hitting the profit and loss. Impairment loss bracket P&L account, debit to accumulated impairment loss. If you say no, I have I'm following revaluation model with respect to the specific asset, okay, and there is a revaluation reserve existing, then revaluation reserve account debit to the extent it is available, and if the impairment loss is over and above that, then the difference amount will be debited to profit and loss, will be debited to profit and loss, right? And if suppose yes, your total impairment loss obviously cannot be greater than the carrying amount, correct? Now after accumulated impairment loss, the carrying amount should maximum it can become zero. No, there is an obligation. There is an obligation. Suppose there is a ban on the asset. That means you are only, the company only has to destroy it. Company only has to destroy it. Under those circumstances, you have to check with Ind AS 37, is there a provision requirement? Correct. The asset value has to become zero, and wherein you have an obligation to destroy with respect to that, if you have a present obligation arising from the past events, wherein probable future economic benefits outflow and where you can measure it reliably, that means if you satisfy the three conditions of Ind AS 37 provision, then you are supposed to make a provision as per Ind AS 37, right? Remember these three things always. One, first thing, you are supposed to depreciate it. Then if you are following revaluation model, revalue the asset as per the respective, it may be Ind AS 30, Ind AS 16 or Ind AS 38, then you revalue it, right? Afterwards only impairment is supposed to be tested. So first depreciation sequence is depreciation, revaluation, then impairment. That means if there is an impairment loss to the asset in the current year, the effect on the depreciation will not be in the current year. Effect on the depreciation will be in the next year onwards, but not on the current year. That you need to remember. And deferred taxation obviously will be applicable because book value is coming down, which will not be considered by income tax department, correct? Now the tax base will remain same, but the carrying amount is going to be down. There will be deferred tax that you need to consider. Next, if you are following revaluation model, sir, will there be any impairment effect? Yes, revaluation model may fair market value only will be considered, not fair market value minus selling cost. So now the discussion is based on the selling cost significance. If the selling costs are significant, then you have to calculate fair market value minus selling cost and value in use obviously. Then you have to check whether there is an impairment loss. No sir, selling costs are hardly anything, then there is no impairment, then just go ahead, revaluation you have done it sufficient, you don't need to follow this standard, right? Do you need to test every year impairment? Right, not necessarily, right? Only when there is an indicator, that may be external indicator or internal indicator, only when there is an indicator, that time you are supposed to do this impairment procedure. If there is no indicator, nothing is supposed to be done. That you can run through. Next, there are exceptions to the above rule. As I said, impairment test should be done only when there is an indicator, but under the following circumstance you have to do the impairment test every year whether or not you find an indicator. These are the only three circumstances. One is intangible asset under development, next one is intangible asset which has indefinite life, and the goodwill which is arising from the business combination. These three circumstances, whether you have indicator or do not have indicator, it has to be tested for impairment every year. Every year does not mean on the balance sheet date. It can be done any one day, right? But you maintain the consistency. That is what important, right? Some points with respect to value in use, right? The management should consider, reasonable and supportable assumptions you are supposed to consider. As I told you, it is present value of the future cash flows. That's why, you have to consider your budgets, forecast, correct? Try to use more of external data compared to internal data. With respect to growth rate, it's better to consider long-term weighted average growth rate instead of recent past 1 to 3 years I'm growing by 30%, so I'm expecting next 10 years I will grow by 30% is illogical. Next, in your future cash flows, you have to consider only operating cash flows, my dear. You should not consider financing cash flows. You should not consider investing also, but subject to one small point, right? And tax payment, tax receipts, no, I have not told. Maybe yes, you are supposed to consider only pre-tax cash flows. We have to take pre-tax cash flows and you have to take the pre-tax discounting rate only, right? And if there is a restructure plan, which is, if it is committed and the balance sheet date by the management, and there is an evidence that these people have started doing the job, then yes, you should consider the future cash flows of the restructured asset, and to construct I mean, you have to consider the restructuring expenditure also, you are supposed to consider, right? If your cash flows are in foreign currency, the foreign currency rate on the date of valuation, on the date of balance sheet date, I mean, that is obviously balance sheet date, you are supposed to consider. Okay, I mean, you are not supposed to imagine, what would be the foreign currency rate at a future date. No, right? Let us come to discounting. If you discuss the discounting rate, that you are supposed to apply the pre-tax rate, but the pre-tax rate should reflect the time value of money and risk specific to the asset. Risk specific to the asset, I mean to say the rate of return, that is IRR from that specific business you are supposed to consider. IRR from the specific business you are supposed to consider, and that's what you have to take. The market opportunity rate you can consider. So initially it is very difficult to do so. Then yes, you can start with by taking the WACC, that is weighted average cost of capital. Under that calculation, I mean, obviously that is weighted average of KE, KD, KP, I mean, whatever you have, which you have learned in CA inter financial management, right? KE has to be measured using CAPM model, right? RF plus beta into RM minus RF, that formula. And if that is also not available, then you have to take the incremental borrowing rate. That is also not available, then you can take other market borrowing rate. But when you're taking other market borrowing rate, say example, you have two business, one is gold business, one is textile business, you cannot follow same discounting rate for both. Suppose if you feel gold is more risky, then, and my borrowing rate has come 10%, then for gold you have to follow 10 plus some 2%, 3% according to the risk. I mean to say, you have to consider the risk factor. So far whatever we have discussed is with respect to individual asset. Now let us get into CGU. Okay, that is cash generating unit. What is cash generating unit? That is the smallest identifiable group of assets. Smallest identifiable group of assets that generate largely independent cash flows from other assets. Smallest identifiable group of assets that generate largely independent cash flows from other assets. You have to prove that this is, I mean, you should start with a small number of group of assets and start adding, at which level you are able to generate independent cash flows without considering any other business, then that is going to be considered as CGU. Okay, right? So one company may be having one CGU or more than one CGU, that is possible, and that is a decision making. Okay, if there is an impairment loss with respect to CGU, right? See, impairment loss calculation remains the same. And how do you account for the impairment loss, right? Is the loss due to, right, first you have to check, is the loss due to only one or few specific assets of the CGU? If you say yes, then that loss should be attributable and should be reduced from the specific asset. Don't allocate it to the all the other assets. If you say no sir, it is not with respect to one or few assets, it is with respect to entire CGU, then yes, then you are supposed to allocate the impairment loss. You have to allocate the impairment loss to all the assets of the CGU in the ratio of their carrying amount. In the ratio of their carrying amount, you are supposed to allocate it. Okay, but after allocation, remember, the carrying amount of the individual assets cannot be I mean, less than, it cannot be less than the fair market value minus selling, cannot be less than the following. Okay, remember, fair market value minus selling cost, or value in use, or zero, whichever is higher. It cannot be less than whichever is higher of these three numbers. Yeah, you have to work on it. If you know it, it's fine. Otherwise, you please practice that specific question which is given in my textbook, that is Ind AS Made Easy. Right now, ninth edition is going on, which you are aware of it. Impairment loss should be allocated to all other assets. That's normal thing, right? Let's get into the important and very crucial topic, that is goodwill. Yeah, goodwill, obviously, which must be arising from the business combination. Yeah, here the question should come whether the goodwill is allocated to specific CGUs or it is not allocated, sir, but it is related to, sir. Yeah, if you say, let's go to the first situation, it is allocated to specific CGU. Remember, if the goodwill is allocated to specific CGU, that CGU has to be tested for impairment every year. Okay, right. If the goodwill is there, sir, but that goodwill is not specifically allocated to any of the CGUs, sir, but is related to few CGUs, sir, then those CGUs need not be tested for impairment every year. That means you have to test for impairment only when there is an indication. Otherwise, it is not necessary to do so. Right. Next. Right, let's go to the first one. When it is allocated, means CGU assets value plus goodwill, then this total value has to be compared with the recoverable amount. If there is any impairment loss, first you have to hit the goodwill, and afterwards, if there is any, correct, after goodwill elimination, if there is any loss, impairment loss further left, that has to be allocated to the parts, each asset of the CGU in the ratio of their carrying amount, subject to above discussion. That means after allocation of the impairment loss, the book value of the asset cannot be lower than fair market value minus selling cost, value in use, or zero, whichever is higher. Okay, right. Next, if it is, if the goodwill is not allocated but it is related, under that circumstance, what are we supposed to do? Right, I told you, you have to check for the impairment only when there is an indication. That means, say example, the goodwill is related to A, B, C. Right, I found indication in B. If I say, right, then you are supposed to test for impairment of which one? CGU B. Right, if there is any loss, that loss has to be allocated to the CGU B's assets only. Right, not to the goodwill. Right, that is first round of checking of impairment loss. Once that round is over, then you have to club A plus B plus C plus goodwill. Then you have to go for second round of impairment checking. Right, and now if there is any impairment loss, now you have to hit first goodwill. Then after the goodwill hitting, still if there is an impairment loss, then that impairment loss will be allocated to A and C, because B is already you brought into recoverable amount. There will be nothing else to be done with. So A and C, you are supposed to do it. Right, and if this right, let's go to the next small topic, that is corporate assets. Corporate assets are nothing but corporate assets cannot be treated as a CGU. Right, these are all like HO assets, these are information system, maybe research center, such things. This corporate assets cannot amount to CGU. That's why what are we supposed to do? First you have to ask a question yourself: can it be reasonably allocable to any CGU? If you say yes, it can be allocable to any CGU, right, it is also one more physical asset, right, then you add it to the assets and you just perform your impairment loss whenever there is an impairment indicator. That's normal. Okay, right. If you say no, sir, I cannot allocate it specifically, then yes, you have to check, to the smallest possible CGU. Suppose says I have CGU 1, 2, 3, 4 are there. You can't allocate this information system to A, B, C, D, 1, 2, 3, 4. Right, then you should check, can I allocate it to 1? Possible or not possible? Then you should see 1 plus 2, is it possible to allocate? No, sir, not possible. Sir, 1 plus 2 plus 3, let me check, can I allocate this information system to 1 plus 2 plus 3? Possible means allocate it there itself. Right, and no, not possible, sir, then it is attributable to the entire company as a whole. Right, under that circumstance, right, allocated to the entire company. If there is any impairment loss and if there is any goodwill to the entire company, then first you have to hit goodwill first, afterwards corporate assets and the other assets of the CGUs. right? That is the one. And the next topic is with respect to reversal of impairment loss, right? Can we reverse it? Yes, yes, you can reverse it. But this reversal, yeah, for this reversal also, if you find, I mean, what is that? When can you reverse the impairment loss? Only when you find an evidence that the company's, I mean, earning capacity has gone up. Remember, the company's earning capacity, that is service potentiality, has gone up. Okay, under that circumstance, whatever the impairment loss you booked in the past, that can be reversed. For this also, external indicator, internal indicators, you can consider it, right? If it is with respect to reversal of impairment loss with respect to individual asset, reversal of impairment loss with respect to individual asset, was it revalued earlier? If you say yes, right, yes, first a credit to the profit and loss to the extent earlier debited to the P&L. Correct. Now, because of impairment loss, if you remember, I told you initially when you had the impairment loss, revaluation reserve account debit to the extent available, then balancing figure will be hitting the P&L. Now in the reversal angle, you have to go. First you should not go to revaluation reserve. First you should credit the P&L to the extent earlier debited. Then balance amount is supposed to be credited to revaluation reserve. Right. If you say no, sir, it was never revalued, no problem. Then the amount, I mean, there is no revaluation reserve means obviously it will be credited to P&L. But remember when you wanted to do the revaluation, correct na? I mean, sorry, reversal of impairment loss. I mean, what should be the amount? What should be the amount? You should be the recoverable amount or the carrying amount. I mean, after reversal, after reversal, your carrying amount should be either the recoverable amount or the carrying amount if the asset was never impaired. Whichever is lower, it has to be, right? Next, reversal of goodwill is fully prohibited. No, because if you reverse the goodwill, it will be assumed you are creating a self-generated goodwill, which is obviously prohibited. That's it, my dear. If you like this video, please share it with your friends, like, comment, and subscribe to the channel, and let this be useful to as many as students as possible. And thank you very much. Wish you the very best.